Okay, welcome to the lecture on the beginning part of Chapter 2. We're going to get started on life insurance. We'll cover most, if not all, of life insurance in this session. So there's a lot of technical details. This is a very important chapter. So you will be quizzed over this and tested over it many times. Well, 2 more times at least. All right. So Chapter 2 covers life insurance, disability insurance, and annuities. And so we're going to get started on life insurance. Probably about 2/3 of the chapter is over life insurance. So start off with some definitions. This is not new information. This first one, the insured is the individual whose life is covered by the insurance policy. That person is the insured. The owner of the policy is the person who can exercise the economic right of the policy and typically pays the premiums, although that part is not can be given away. So the owner is the person who can say exercise the economic right. Basically, this is the person who gets to name the beneficiary. This is the person in control of that. The beneficiary is the person who's entitled to receive the death benefit. What you don't want to have, typically the beneficiary and the insured are never going to be the same person, right? I'm not going to have a life insurance policy on myself as the insured and name myself as the beneficiary. The owner of the so those two are, almost always separate. The owner of the policy can be a different person. What ends up happening is if the owner of the policy is not the insured and not the beneficiary, we can end up getting into trouble. So if the owner needs to be either the insured or the beneficiary. Otherwise, the life insurance policy is not taxed as ordinary income. However, the owner of the policy is said to have made a gift. So if my wife owns a policy on me and my son is the beneficiary, the IRS is going to say, hey, wait a minute, to my wife, you could have made yourself the beneficiary. You chose not to do that. And therefore, that you are deemed to have my wife will be deemed to have made a gift to my son for the death benefit amount. Now, if that could be subject to gift taxes, if my wife's estate in gifts, the amount that she passes during her lifetime exceeds the lifetime maximum, which is, I think it's $5.3 something million this year. So, insured, owner, beneficiary, these are important concepts. So, life insurance and mortality risk. So, basically the risk exposure is from dying early. And what is early? Well, in this case, we want to, insurance, as we said in the past, is going to insure 2 things: income or assets. If we're insuring income, then life insurance is the risk exposure from dying early. If we're insuring assets, life insurance is the risk exposure from the government taking part of my estate because I died with too much money, so I may be able to insure that to do asset replacement for that. So that is not necessarily the risk exposure from dying early. As a person gets older, the chance that a person will die within the next year increases. This is obvious. Obviously, somebody age 87 has a lot more probability of dying within the next year than someone who is 27. However, this is not universal. Children who are just born, children are more likely to die in their first year than they are between, let's say, 11 and 12. So this is not universally true, but it is generally true. So, as we talked about, the primary motivation for life insurance is through income replacement. So I need to replace my income for my family. That's the primary thing. But there may be a readjustment period. My wife works part-time as a nurse. If I were to die, I'm not available to provide, to be at home to provide any child care when my wife's at work if I'm dead. So there might be a readjustment period where she needs to take off for some period of time before returning to work. So that would be costly. Also, she probably would just be sad and probably not want to go to work the next day, and that would end up costing her money. So it's not just for my family. I need to provide for anybody who is relying on me economically. So if my parents rely on me for some financial support, I will need to do that. Lots of people will, if they are big donors of their church or for some charity, will also then create a life insurance policy for them, where they name their favorite charity as the beneficiary. And also people will not only consider the income replacement and income and goals, but they'll also consider any debt that is available there. So the other goal is estate preservation. We can be talking about medical expenses prior to death, although if we have health insurance that would pay for those things, then, or long-term care insurance that would pay for those things, then life insurance is less about estate preservation. If we don't, then these can significantly drain these expenses can significantly drain financial assets, which can then be made up after death via life insurance. And also, there's a cost for a funeral, and this is true whether it's the risk of dying early or the risk of preserving the estate. Various states have different probate expenses, and states also have estate and inheritance taxes as well. New Jersey is one of the only states in the country that has both estate and inheritance taxes. In other words, the person who dies, their estate pays the taxes, and then the assets are transferred to the heirs or the beneficiaries. Well, heirs has a specific meaning legally, but just broadly using the term heirs, the assets are transferred to the heirs, and then the heirs will pay taxes on that above a certain amount of money that's transferred. And of course, cash to pay estate taxes, that is the biggest one for some people. The measuring the life insurance need, there are three basic approaches. There's the human life value approach, which basically says if this person had not died, how much would they have contributed to their family? It's basically a loss of earning power, but also the services that maybe I do for my family that I'm not paid for. So I cut the grass, I clean out the gutters, I do certain things like that goes into the economic value of my life to my family. An economist may be testifying for this in a wrongful death case. Let's say if I was killed by somebody for drunken driving, and then we were suing and it went to court, an economist would probably testify to the economic value that I provide to my family. Also, as I earn Social Security benefits. Those Social Security benefits would be there for my family. So it's not just specifically replaced earnings. It's also the value of the services and the benefits that I earn for my family. The needs approach, I'll get to that one last. Then we have the capitalized earnings approach. So this is based upon, okay, this is how much I earn, and so if let's say I earn $100,000 a year, let's say prevailing interest rates are 5% a year. In order to earn $100,000 a year at 5%, how much would my wife need to have and not have the principal value go down? Well, she'd need to invest $2 million at 5% in order to get $100,000 a year, and that's not even considering inflation. We'll get into some examples of that, perhaps coming up and then in class. The needs approach is basically the financial planning approach. We look and say, okay, who's relying on you economically? What are your goals? And how close are you to funding your goals? So if you're pretty close to funding your goals, then your need for life insurance goes down. So if I have $5 million, in the bank, my need for life insurance goes down relative to if I have $5,000 in the bank. So because that $5 million is basically a form of self-insurance, I can self-insure that my family would be able to reach the goals. So this is vastly different than the human life value approach. The human life value approach wouldn't consider my goals at all. The needs approach would consider my goals relative to how much they're funded. So here's the steps in calculating the human life value approach. Determine the client's annual earnings, subtract personal expenses, determine the remaining work-life expectancy, calculate the future value of lost earnings for the family, taking into consider expanded growth rate of earnings, and then calculate the present value of the family's share of earnings at the inflation rate to determine the human life value. These are the steps, and so we got to go through. We'll go through some examples to see what that means. The needs approach. The planner will estimate the cash needs of the family require at the death of the insured. So this is kind of an intermediate term to pay for an adjustment period and to pay for funeral and final expenses. So here's the list of these things. Final expenses. Debt will be eliminated. So I won't consider my need to pay off my mortgage because I'm going to pay off my mortgage on an ongoing monthly basis. I'll kind of subtract that out of my living expenses because it's going to be assumed that I'm going to retire debt. So the funding of specific goals such as education for children, income needs for the surviving spouse and family, that's the primary one, and then the retirement needs. So this is where, okay, it's going to cause there's an effect of losing Social Security or any retirement benefits that I would be accumulating through work. So F stands for final expenses, funeral and final expenses. There's this readjustment period that happens, as we talked about. There is the education goals. So there's final expenses, retirement, education, elimination, and then elimination of debt. So that's FREED, freed. The capitalized earnings approach. There's no need to determine work-life expectancy because we're going to assume that you're never going to spend down the principal. I pretty much explained this on the previous slide. So here's a capitalized earnings example. So we are going to consider raise and inflation rate. We're going to use the risk-free rate of return. Currently it's not it's not 6%. But we use the risk-free rate of return as the assumed earnings rate, and then we're going to and then we're going to make an adjustment where we're going to combine the risk-free rate of return and the inflation rate. And then we'll assume that there's a certain amount of consumption that I do. So if I died, I cost money for food and clothes, so those expenses, and probably an additional car, so those expenses, and auto insurance, things like that. Things that I buy football tickets. My wife won't be buying any more football tickets if we go on vacation. She's still going to have to pay for hotel, but she's not going to have to pay for my airfare. Things like that. So we'll assume that my wife's expenses are going to go down by 20. My wife's remaining expenses, the family expenses, are going to go down by 20%, 25% by issue of me not being there. And then really, we're looking at an after-tax thing. So we're going to subtract out the federal and state taxes. So this is the effective. This assuming that I'm at an effective rate of 25% at federal and state taxes. So the denominator is the inflation-adjusted rate of return. You have to figure out how to do the inflation-adjusted rate of return, and here's the formula for it. And this will be useful not just in this exercise, but in many exercises for you. It's 1 plus the riskless rate, so 1.06, over 1 plus the inflation rate, 1.03. So let me, I'll pull up a calculator for you. Divided by 1.03, and that equals 1.0291. I subtract 1. Basically, my inflation-adjusted rate of return, if I earn 6%, it's not, but inflation's 3%. My inflation-adjusted rate of return is actually a little bit below 6 minus 3, which would be 3%. It's about 2.9%. So I'm going to leave this in decimal, in decimal function, and I'm going to say, okay, $100,000 a year is what I make before taxes. I spend about $25,000 a year that my family won't be spending, but and then we pay $25,000 in taxes. So we live on $75,000 after taxes. My wife and family will live on $50,000 after I'm gone. So we divide by the inflation-adjusted rate of return. So to replace $50,000, my wife would need to invest 1.76, a little over $1.3 million in order to replace my income, and also she would never lose the principal value. So there are 3 basic types of life insurance, and I'll add a 4th to this, which would be called variable. But basically, in broad categories, there is temporary insurance and permanent insurance. The only type of temporary insurance is term insurance. Universal life, whole life, and variable life, and then you can have variable universal, where you combine the features of both variable and universal, and so you get that. The basic type of permanent insurance is whole life insurance. So we're going to do term, and then we'll skip ahead to whole life and come back to universal and variable. So term life insurance is pure insurance. Other permanent insurance, all permanent insurance products have both a savings feature and an insurance feature. The term life insurance has only an insurance feature. So there's no cash value component with that. The other types of insurance products do have a cash value product. This is very inexpensive at young ages, but as the chance goes up that I will die in the next year as I age, the insurance, the cost of providing that insurance increases. So the most fundamental pure type of insurance is annual renewable term. I set the premium and it's just good for 1 year, because really what's being insured is the chance that I'll die over the next 12 months. So for me, 37, chances are higher that I'll die than it was when I was 27, but not as high as it'll be when I'm 57. So so we can think of this is, just the actuarial probability that I will die, that someone my age will die in the next 12 months. So we can apply what we've previously learned, the expected value of the loss, so the probability that I'll die. So I can do probability that I'll die times the cost of the death equals the expected value of the loss, and the insurance company is going to probably charge me a little bit more than the expected value of the loss for the next year. So term life insurance provisions, renewable. You want to be able to renew without evidence of insurability. So if I have so if, let's say I have annual renewable term, this means that when I buy the insurance for the first time, I am going to have to go through some underwriting, which means I'm going to have to go through and tell them my health history, my family health history, and I'm going to have to go through some medical screening. But if once my term expires, it's just based upon the premium will be just based upon my age, not based upon my health status at the time. So if I've got, we'll get into this a little bit later, but I talked about annual renewable term as the most basic type of insurance, but I can get a level term policy where the premium is not going to go up for, let's say, 20 years. 20 years from now, I'm actually 38, just turned 38. So the premium will go, if I get a 20-year term policy, the premium will be flat from age 38 to 58. And how they figure that is they say, okay, here's what it would have cost for annual renewable term at 38, 39, 40, 41, 42, and they basically do sort of a weighted average, considering that they'll be able to invest the funds, and also considering that I could develop some health insurance and some health needs during that time. But it'll still be a fairly low rate. At the end of that 20-year period, if I still have a need for life insurance, then I might want to be able to, it'll turn into an annually renewable policy. But I won't have to go, generally I won't have to prove insurability after the end of that 20 years. The fact that I don't have to prove insurability probably means that it puts a bigger risk on the insurance company. So the fact that I don't, so that means they're going to charge me much higher premiums at age 58 than if I did have to prove insurability, because chances that I develop some health thing in the next 20 years are pretty good. And so if I'm in good health, I'm going to actually prove insurability and lock in a lower rate. If I'm in bad health, I'm going to not prove insurability. So they assume that only the people who are in poor health and are more likely to die are going to continue to pay the annual premiums beyond the 20-year term. So this is something to think about, this prediction. This is known as adverse selection. Some policies are convertible, so I can convert a temporary insurance policy into a permanent insurance policies. Many policies have that, and then there's a waiver of premium feature, which if I become disabled, then I'll probably still need to have some life insurance, but if I become disabled, that it would waive the life insurance premium. And this is often an add-on that slightly bumps up your premium, but not too much. So, term life insurance limitations: if we have older age people for annually renewable, it's going to, the chances that I die are very high in the next year, are very high for someone who's pretty elderly, so they call that exponentially increasing premiums. But it's based upon the mortality tables. Most term policies are lapsed without collection by the insured. Also, so people start to think of life insurance and a little bit like an investment, just the way that people mentally frame it. It's not pure insurance. People think of their auto insurance and their homeowner's insurance really as pure insurance. But a lot of people go, wait a minute, I'm going to pay $1,000 a year for 20 years, and if I don't die in that 20-year period, you mean I don't get any money? So they start to have some regret factor. So that's why there's this return of premium feature that's often in there, and also convertibility starts to help people overcome some of those behavioral hurdles. There is no savings component, so it doesn't bill cash value, unlike a permanent insurance policy. And then right now my primary need is for insurance is income replacement, but if I'm pretty successful at building wealth, I may have a permanent insurance need, which would be asset replacement. I could also have a permanent insurance need if I have a special needs child or grandchild who will outlive me. Then that would be something. Let's say if I have a child that has special needs that will require me to care for them well into their adulthood, then I might have a permanent need for life insurance as well. And that would, again, be income and service replacement. So term life insurance policies, we talked about annual renewable term being the basic type, and this is how group insurance is priced, is sort of group annual renewable term. But not a lot of individual annual renewable term is sold. Mostly level term is sold. Decreasing term is something that makes a lot of sense, but it doesn't tend to end up being priced right. So a lot of decreasing term says, okay, as time goes by, the value of insurance that I need goes down as I save more and more money and get close to retirement. I will have the cash that I will have saved goes up. So considering the financial needs approach that we talked about, so that makes a lot of sense. Also, if I'm considering paying off debt and I've got a 30-year mortgage today, 20 years from now I'll only have 10 years left on my mortgage, I'll need to pay off a lot less in terms of debt. So decreasing term insurance. What is sold is often mortgage insurance to pay off the mortgage, and it's sold that way. So the premium increases annually every single year, and the chance that I may die in each successive year increases. The death benefit is fixed. So this is the most inexpensive in the early years form of insurance, and therefore provides the maximum death benefit per dollar spent. And then most annual renewable terms can be converted to a permanent policy without proving insurability. The disadvantage: if it's cheap when you're young, it's costly when you're old. There's no savings component in any renewable, in any term policy, and the premiums, your budget gets more and more constricted each year because the premiums increase. Level terms premiums are fixed for a period of time. I talked to you about how this might be priced. Death benefit is fixed, so if I buy $1 million policy today, it's going to be $1 million policy 19 years from now. So basically, I said you prepay some mortality costs early on, and so that my budget doesn't go up when I get older. Okay, talked about decreasing term as well. So here's some advantages of a level and decreasing term. Premiums are level. It still is a pure death benefit protection. There's no cash value increasing, so it's pretty inexpensive, although not as inexpensive as annual renewable term. Most of these can be converted to a permanent policy without proving insurability. Disadvantages are that you overpay premiums relative to early on, relative to annual renewable term, and there's no savings component like all term policies. So we use term life insurance for the temporary life insurance need. I have a very long temporary life insurance need, probably until my late 60s. Decreasing term is really to pay off, is really debt elimination, but it could also be used for it could also be used for general life insurance need, if I was very confident that I was going to be saving consistently, and therefore my net worth increases, so without my lifestyle increasing much significantly, so that my need for life insurance is going to go down in a pretty predictable manner. I'm going to skip ahead to whole life insurance, and then we'll go back to universal. Whole life is permanent life insurance, as is universal. The whole life policy kind of works a little bit like a level term policy in that mortality costs are prepaid early on. So I've got a fixed premium that I'm going to pay every year. And so basically a whole life policy works like this. I've got a fixed premium that I'm paying every single year, and a portion of that premium is going to be cash savings, and a portion of that is going to be buying an annual renewable term policy. So if I buy the whole life insurance policy at age 30, very little of that premium is going to be going toward the annual renewable term, and the vast majority is going to be going toward increasing the cash value. Let's say my cash value increases by $4,000 over the next year. I got a $5,000 term. $1,000 goes toward the buying the annual renewable term, and then $4,000 goes toward increasing my cash value. Next year, because I have a $4,000 cash value, the insurance that I need to buy is only $996,000. But I'm more likely to die in the next year, so my premium, the cost of buying the annual renewable term, goes up a little bit, and I may only build my cash value by $3,800 over the next year. So the annual renewable term may cost me $1,200, $3,800 gets added to the cash value. So I start to build my cash value, more of it goes toward cash value early on. So that's how that works, and we'll give an example and draw a visual of that in class. So in the basic form of whole life policy, the premium is level until, for the rest of my life or until age 100. Lots of times it'll be set that I need to pay it by age 65 or some date at which I'm going to retire. So here's an example of premium and then mortality cost, and then we've got some overhead and profit, and then the savings component. So here's a visual of what I just talked about. One of the advantages of whole life insurance is that the cash value may be used for loans or may be received as the policy is surrendered. Particularly on the loan side, this is beneficial because if I borrow money, it is not considered. It's not considered income. So if let's say I have $500,000 cash value life in my cash value life insurance policy by the time that I retire, that money that goes in the cash, there's a premium that's going to be paid my annual renewable term, but the cash value is going to grow, and it's going to grow on a tax deferred basis. So I'm not going to pay taxes on that. And if I can actually access that cash without getting it as income, so I'm going to have principal and interest. I can access that cash by borrowing money against it in a whole life policy that is not in a cash value, any cash value or permanent life insurance policy that's not a MEC, a modified endowment contract, and we'll get into what that means in a little bit. And then cash values have a minimum guaranteed rate of interest, and this is guaranteed by the insurance company. If for mutual insurance companies, whole life policies receive dividends. If there's not, they don't receive dividends. Dividends, and we'll talk about what you can do with those dividends as well. Dividends in the investments world are pass-throughs of earnings, so those are taxable. Dividends in the life insurance policy world are considered, well, you paid me some money and I gave you some of it back. That's not considered earnings. It's considered a refund, and dividends are therefore tax-free. So we've got ordinary life, as we talked about, where we'll pay it to age 100 or until death, whichever comes first. Limited pay life, the premiums are higher, but you only pay for, let's say, until age 65, or I want to pay it off over the next 15 years. That'll be a 15 pay, or there's a 10 pay. You have to be careful when you do, let's say, a 10 pay, and we'll talk about that when we get to the max. There are variable contracts where the cash value is invested in stocks or bonds, and so you've got variable rates of earnings. In variable contracts, the insurance company is not guaranteeing the rate of return. The insurance company is not guaranteeing the entire rate of return. Also in universal, we'll see that the insurance company is not guaranteeing the rate of return, but you're not investing in stocks, bonds, and money market mutual funds. In a variable life insurance contract, the death benefit and cash value fluctuate based upon the investment performance. So I don't have a fixed thing, unlike a whole life insurance policy contract. Advantages of the whole life policies: you get tax deferred growth of cash value, permanent protection until age 100, and at age 100, sometimes it's 110, depending upon the insurance company's policies. By age 100, if I bought $1 million policy, my cash value will equal my death benefit, and I can therefore then take that money. There may be some tax consequences, but we'll get into that later. Disadvantages particularly relative to term insurance, is the policy is very expensive. In pure whole life policies, we have a very inflexible premium, and the cash value growth is pretty gradual because the insurance company is investing in, the insurance company is investing in bonds, and they guarantee a fairly low rate of return given whatever, relative to the interest rate environment. So given the fact that it's pretty expensive, the insured might not be able to purchase as much protection. You as the advisor need to understand that the most important thing is that you purchase the right amount of coverage, and then the next most important thing is that you get the right type of policy. The amount of coverage is the most important. So if the client can't afford it, you need to look for ways that they can afford the right coverage rather than sacrificing the death benefit. So what are the appropriate uses? Anyone with a permanent life insurance need, and that is typically for estate planning purposes, but it could be if I have a special needs child, as I talked about. And but we talked about the estate planning purposes to pay estate taxes. So those are the primary reasons for whole life insurance. Some insurance agents will tout the tax-deferred ability, but you've got that insurance component to it, so that if you're just looking to compare it as an investment vehicle, that is not such that's not such a great thing. But when you couple it with the ability to borrow against it, borrow against the cash value without having to pay any income taxes, it gives you ability to manage your taxes in retirement. So we will reserve judgment based upon that. I'm going to, at this point, before we get into first to die and second to die policies, I'm going to go backwards and go back to the universal. So universal is really flexible in terms of the premiums. Generally, pure variable policies are not flexible in premiums, but the death benefits can fluctuate based upon the performance. Premiums are flexible for universal policies. The face value or death benefit and the cash value all will fluctuate based upon performance and the amount of premiums that you pay. The insured, unlike the variable insurance contracts, a pure universal life insurance contract, the insured does not direct the investment portion. But unlike the whole life insurance contract, the guarantee, there is less of a guaranteed return. There may be a minimum that you can earn in a universal life insurance contract, but it is the minimum is a lower guarantee by the insurance contract, by the insurance company. So the insured is taking the interest rate risk. In the whole life policy, the insurer is taking the interest rate risk. In universal life policies, the cash value can be used to pay the premium. So if I built up some cash value and I decide I want to skip making premium payments, then I can use my built-up reserves to pay the premium. That will decrease my face value, but it will not lapse the policy. The way that these work specifically varies. There are two types of pure universal life policies. Universal A, the flexible premium, is the adjustable death benefit in an unbundled life insurance contract. The beneficiary receives the cash value or death benefit, whichever is greater. Universal B is that the death benefits vary directly with the cash values. So Universal B is more expensive than Universal A because basically you get death benefit plus cash value. Universal A is you get either or. Variable is a product that has the same investment options. So the most flexible type in a variable non-universal life policy, in a variable whole life policy, you have a fixed premium. In a variable universal life policy, in a variable whole life policy, you have a fixed premium, and you invest in securities, stocks, bonds, etc. And the insured directs the investments in a variable whole life policy. In a universal life policy, the insurer directs the investments, but doesn't take as much interest rate risk as they do in a whole life policy. But what is flexible is the primary thing that's flexible is the premiums and the death benefit. In a variable universal life policy, basically everything is flexible. Death benefit's flexible, but it comes with the variable investment options that are available in the variable whole life contract. So this is the variable universal life is the most flexible. Universal life policies, the policy owner determines the frequency and amount of each premium. The death benefit may increase or decrease. So this is one. So a variable universal policy may be one in which, if you're buying it for the investments piece of it and to be able to borrow against it in retirement, you probably would use something that is like a variable universal life policy. And we get into that. We will now go. Okay. Permanent life insurance policies can be first to die or second to die. So a first to die policy basically says, okay, my wife and I are buying joint life insurance, but it's only going to pay a premium when the first person dies. So the reason that I'm buying that is to provide some benefit for the survivor, whoever the survivor is. A second or last to die policy, I don't care about providing a benefit for the survivor. I'm going to provide the benefit when estate taxes are due, because this is the thing about estate taxes. I'm not going to test you on this per se, but I do want you to know this as it relates to a second to die policy. When a married couple, let's say they have $15 million, I can, if let's say it's my wife and I, and I die first. If I leave everything to my wife, there are no federal estate taxes due on that, because there's this unlimited marital deduction. The estate taxes will be due when the second spouse dies, and there comes an intergenerational or any non-spousal transfer. So that's why you have a second to die or last to die policy. Dividend options. We talked about dividends being basically just reviewed as the IRS by return of premium, so they are not taxable. You can receive them in the form of cash. You got to memorize these things, and you got to know what these means. So these mean. So this is an important slide. You can get it in the form of cash and put it in your pocket. You can receive what are known as paid up additions. So this will slightly, and it's a permanent life insurance policy, this will very slightly increase the death benefit. So it's 1 year. Let's say I get a dividend of $500. How much will that? I will buy a death benefit that will be paid up, 1 year paid up deal. I can use it to increase my cash value. Or I can use it, I can say, okay, you're giving me some money back, but I'm going to end up owing a premium to you next year. Just take that and credit it toward my next year's premium. Or I can buy 1-year term. So the 1-year term and the paid up additions both buy additional insurance. The paid up additions don't buy much more insurance, but it's permanent insurance. The 1-year term increases my death benefit for that year. So depending upon, if I'm terminally ill, I should use this 1-year term because I don't have to prove insurability. That is going to increase my death benefit the most. So understanding how these work and how you would use them is something that I want you to understand and be tested, and I'm going to test you on it. Surrender charges. So there is cash value. Normally, if you surrender, you're going to get you're going to more or less get your cash value, except if you surrender fairly early on, because there are sales costs and administrative costs that the company, the insurer, incurs in terms of dealing with that life insurance policy. So you might not actually build cash value very much in the first couple of years because the insurance company is going to try to recover its costs in the first couple of years, and then it starts to take off. The way that they do this is they say, okay, even if you are building cash value fairly early on, the cash surrender value will probably be a lot less in the early years than the cash value. If you surrender your policy, I'm not going to give you the full cash value of it. I'm going to give you the cash surrender value. Non-forfeiture options. So in a term policy, if you don't pay your premium, they just cancel your policy. Now there are ways that you can get it reinstated within certain windows, which we'll get to. But you need to understand. In permanent insurance, you're building this cash value. So what happens when they're not going to just cancel your policy. They're going to give you what the cash surrender value in the policy. So if you let your policy lapse, you either get the cash surrender value, or you can say, I would like to have reduced paid up insurance. I have a cash value, not the cash surrender value, but I have a cash value of, let's say it's $20,000, reduced paid up insurance, and let's say it was a $500,000 policy. How much would this $20,000 buy me? Well, depending upon my age, it may buy me $150,000 worth of insurance, so I get reduced paid up insurance. Or I can say, okay, I'm going to let that cash value continue to buy me paid up term insurance, basically prepay a level term policy for me for some period. And so let's say I have that $500,000. It's going to buy a $500,000 level term policy as long as that cash value will pay the premiums. Getting a little bit more on the variable policies. The major exception, the major difference between universal and variable is it permits the owner of the life insurance policy to direct the investments, and it's not just going to be in bond instruments. It can be in stock and bond type instruments. The variable universal policies are the ones that is the one that's the most flexible. So, pretty important set of slides here, 38 and 39. So, comparing the types of policies. Term life is the premium is fixed if it's a level term policy. If it's annual renewable term, it will be variable. Whole or ordinary life insurance has a fixed premium. Variable only life insurance has a fixed premium. The universal life insurance and variable universal life insurance. So if it has the term universal in it, it is variable subject to a required minimum. Death benefits are fixed only in term and whole life policies. The universal life policy may increase above the face value amount depending upon the cash value. So it's sort of going to have a minimum. Variable has a minimum that is lower than the universal minimum, but can increase more with good investment experience. But it's based upon the cash value, and the same thing for variable universal life. So variable and variable universal life have the lowest minimums, but the highest the highest potential in terms of increase in cash value. The insurance company controls the investments. There's basically no investment for a term life because there's no cash value. The insurance company both controls and guarantees for a whole life. They control and guarantee only a minimum for the universal life. They offer no guarantee on the return for variable and variable universal. The variable is where you have a lot more control over the investment options. There's no rate of return on term policies. There is a fixed and guaranteed rate of return. Fixed and guaranteed rate of return on whole life policies. The minimum is guaranteed on universal life, but may be higher depending upon interest rates, even though they say, hey, basically the insurance company is passing through interest rates. So on average, you're going to get a little bit higher return on universal life than on whole life because the pass-through rate does not have as high of a guarantee. On a variable universal life, you got no minimum guarantee on returns at all, but you only have minimum guarantees on the death benefits. So you can see here the uses, and we address basically all these. I will test you heavily on the uses and when it is used to be, what is appropriate use on slides 38 and 39. You can go back. Basically, this covers the previous 15 or so slides. So pretty important slides here. Dividends are not taxable. They're considered return of premium. Except in the case that if dividends exceed premiums, then the dividend is taxable if it exceeds the premiums paid. If you take them in the form of cash. Okay, here we get to this term called a modified endowment contract. So, insurance companies said, hey, listen, we have this special thing where the cash value grows on a tax-deferred basis, and you can borrow against your life insurance value, cash value, and never have to pay taxes. So it's effectively a way to withdraw the money. But then the IRS said, wait a minute, this is open to abuses, and in fact insurance companies were saying, hey, we want you to really sock a lot away. So in a situation where you could prepay a lot, or let's say a one-pay policy, that is necessarily going to be a modified endowment contract. So the IRS said that there's this corridor at which the cumulative premiums paid cannot exceed cannot approach anything like the death benefit. So so basically, the MECs follow all of these. Start to follow these retirement plan rules. So if you take money out of a MEC before age 59 and a half, there's a 10% penalty. If we have money that's in a MEC, and you take money out that's not a loan, or is a loan, it doesn't matter. However you take the money out, and they say you're withdrawing interest first. It's taxed on the last in, first out basis, and so you're going to pay 100% ordinary income taxes, whether you call it a loan or not, or withdrawal on a modified endowment contract. If you take a withdrawal from a non-modified life insurance contract that is not considered a MEC, then it is a first in, first out, and what went in first was the premium. So you take your cash value out first. And so a lot of people will say, I'm just going to take withdrawals to the extent of my basis, and then I'm going to, and then I'll maybe start taking loans once I get into earnings, interest that's on there. I'll borrow against that value. So basically this idea of a MEC was based upon the IRS trying to prevent some abuse. And so let me show you an example of what this looks like. Okay, so here in the right column is this 7-pay test. So based upon this, they say, okay, this is the cumulative premiums that can be permitted to be paid over the first 7 years. So if you got a life insurance contract, you can really overfund it significantly after the 7th year. But in the first 7 years, they say, hey, we don't want you to do that. So they still leave a little bit of a room for a loophole. So policy 1 pays $2,000 in premiums a year. That's what they're saying is the maximum that's allowed to be paid based upon this example. So anytime you can't go over a total of $2,000, $4,000, $6,000, $8,000, $10,000, $12,000, or $14,000 paid. It's not $2,000 a year. It's the cumulative amount that's paid. So if I, for example, pay less than $2,000 in 1 year, that amount carries forward to the next year. So I pay in year 3, I can carry that forward to year 4, and I can pay the $3,000, and I still will not be, above the cumulative premiums paid maximum. However, if I then at any point go above the cumulative premiums paid, which policy 1 does in year 5, if I go above the cumulative premiums paid, then I will be forever considered a modified endowment contract. So this is the 7-pay test. However, if we see here, as long as I stay under the amount, even though I contribute $3,000 in a year, in year 7, that's still fine because the cumulative premiums paid for the policy 2 still never in any year exceeds the 7-pay MEC test. So this is how it will work. So how do you get this? As I said, you can withdraw a basis and or you can take loans, or you can do both. You withdraw the basis and then take loans against the earnings. So how can you take, if you surrender the policy, how can you take the cash value or the cash surrender value? You can take it as lump sum. You can take it as, you can say, okay, hold this in an account for me and invest it to earn interest. Interest is always taxed as ordinary income, so that's fine. Or you can receive it in installment payments, and a portion of those installment payments say, okay, I've got $500,000, pay me $1,000 a year. They say, okay, well, of that $500,000 cash value, you paid $300,000 in premiums, you have $200,000 in earnings. A portion of each of that $100,000 payment, let's say 60% is return of principal, 40% is interest. That's how installment payments work. So premiums are not tax deductible by individuals. Group life insurance paid by the employer are deductible by the employer, but that does not mean that the death benefits are ever going to be taxable. Premiums paid, because here's how it is: the premiums paid by the employer are taxable income to the employee, except for this de minimis thing here, which is the first $50,000 in coverage is not taxable on the employee. This is called imputed income. So, for example, and you'll run into this lots of times in your work. You probably will not ever notice it, but it does. It will. I'm sorry, something just popped up on the screen that I didn't expect to see. But it will affect your income taxes. So you'll get $50,000. So let's say I make $100,000 a year from William Patterson. William Patterson provides a group life benefit that's equal 2.5 times to my salary. So they will pay for me $250,000 worth of insurance. So the first $50,000 that they pay for me, I don't have to pay taxes on. But the premium that they pay on the next $200,000, I do have to pay taxes on. And we'll do some examples of that in class as well. So death benefits are almost always, not just generally, but almost always excluded from taxable income. Dividends are not on cash surrender value, generally not taxable until withdrawn. And it's never, cash value is never taxable if it's withdrawn at death. It's only taxable if you withdraw it before death. So if an individual owns a life insurance policy on his or her own life, if the proceeds of the policy are made available to the executor of the estate for the death benefit, the benefit will be included in the owner or insured's gross estate and may be subject to estate taxes. So you cannot, life insurance, so we talked about not being income taxable. If I own the policy, then the insurance proceeds are included in my estate. If someone else owns the policy, let's say my executor owns the policy, and I make my executor the beneficiary so that I don't have, 3 different owner, insured, and beneficiary. So I make the owner and the insured, the owner and the beneficiary the executor of my estate, and then I direct the executor to pay the estate taxes on that. Then I have exercised control over it, even though I was not the owner, and it is as if I were the owner, and so those life insurance proceeds will be includable in my estate for tax purposes. So let me look up and see what the 2000, I believe it's like 5.35 million for an individual, 2014. Estate tax exemption. 2014, let's see. So 5.34 million. 5.34 million. Okay. So if I, to the extent that my let's say I die with $4 million and I have a $2 million life insurance policy that I own on myself, then even if somebody else was named as the beneficiary, my estate would be said to be worth $6 million, and I would have to pay taxes on the amount. My estate would have to pay taxes on the amount that exceeds 5.34, or on $660,000. Loans against life insurance contracts are considered tax-free unless they are MECs. So, exchanges. This is important. Exchanges for life insurance. So, annuities and life insurance are both considered insurance contracts. Annuities are death benefits on life insurance are generally almost always not taxable. The benefits on the growth on annuities is taxable based upon an exclusion ratio, and we'll talk about that later. But there's something known as an exclusion ratio. So you're going to they exclude. It's basically this: they exclude the premiums that you paid for the annuity. They just tax you on the earnings that are paid out, and it's assumed that annuity is basically like an installment sale that pays you for the rest of your life. So until you reach life expectancy, by the time you reach life expectancy, you will have recouped all of your premium, and after life expectancy, if you live beyond that, 100% is considered earnings and will be considered taxable. So Uncle Sam doesn't like the fact that you're not paying taxes. So in a life insurance contract, we can exchange one life insurance contract for a life insurance contract. Let me see if I can get my mouse to show up. I can exchange a life insurance contract for a life insurance contract. That's tax-free. I can exchange an annuity for an annuity. That's tax-free. So basically, non-taxable benefit, non-taxable benefit, tax-free. Partially taxable benefit to a partially taxable benefit, tax-free. I cannot exchange a non-taxable benefit for a taxable benefit, and they'll say, okay, you can do that tax-free. But I cannot exchange a partially taxable benefit for a completely non-taxable benefit without incurring some taxes. So I can exchange an annuity contract for a life insurance contract only if I pay taxes. I can exchange a life insurance contract for an annuity contract. That is a tax-free deal. So the cash value, I could do this exchange. It's known as a 1035 exchange, and say, hey, I don't need this life insurance contract anymore, but I'd like to buy some retirement income. Okay, you can do that tax-free. Hey, I don't need this annuity. I have more than I need. I cannot exchange that without tax consequences. So I can't do it. Basically, I can't do a 1035 exchange. Transfer of a policy for value of a life insurance contract. So if I don't need a life insurance contract on myself anymore, and the market value may be worth more than the cash value in the contract. So so basically I could sell that to an investor. So at that juncture, if an investor buys this contract and they pay me, let's say there's $1 million policy on my life, they pay me $100,000 for that policy, figuring that there's a better than 10% chance that I'll die before the policy expires or whatever. They pay me $100,000. I take the $100,000. If I die, they have made a $900,000 return on their investment, and so then they are taxed on the $900,000 to the extent that the death benefit exceeds proceeds. So this is the situation in which death benefits are taxable. In other situations, death benefits are not taxable. So the transfer of value, so I explained that situation. Here are the exceptions to that rule. If my insurance, let's say my employer bought a life insurance contract on me because I provide some value to them, and I'll say I'm a top salesman. And now they say, hey, you know what, we don't really need this policy on you anymore. You moved out of a sales role. I'll sell you the policy. Okay, I might want to buy that policy. So if it's transferred to me, then they say, no, that's okay. Or a business partner of the insured, transferred to a partnership. So if there's a legitimate business reason for that person, if I have an insurable interest in myself, or I have a business that has an insurable interest, then the death benefit will not be taxed, even if the death benefit exceeds the amount paid. Only if it's sort of pure speculation, as we talked about in this case. So, viatical settlements. If I am terminally ill, this means that I'm expected to die within the next 24 months. I have stage 4 cancer or something like that. And I have $1 million contract on myself. I may be able to sell that $1 million contract to somebody for $850,000 so I can go live it up. In that case, then the policy is not subject to income tax. So transfer of policy. So here's one that's speculation that I might die. This one is creates a viatical settlement. The reason that they created these viatical settlements and made it nicer from a tax standpoint is so that the market value would go up, so that the insured would actually receive more value. Accelerated death benefit is basically a viatical settlement. Viatical settlements are with a third party. An accelerated death benefit is basically a viatical settlement that's built into my insurance contract with my insurer. So it can say, hey, it might be a provision that's in my contract that says, hey, I can actually receive the death benefit if I become terminally ill, and not have to wait until death. Group life insurance. So, and group whole life insurance allows the employee to accumulate savings for retirement through cash value. Not widely offered by employers. It's typically group policies are group term policies are generally more widely offered by employees. Premiums paid by the employer are taxable to the employee with that $50,000 exception. Here's an example. Frank, age 40, earns $75,000 a year and has a group term life insurance policy through his employer equal to twice his salary, so $150,000. There is imputed income, or known as phantom income. Even though Frank does not receive the check, he does actually receive a benefit because his employer is buying insurance for him. The monthly cost for excess coverage is $10 per thousand for someone age 40. So the death benefit, $150,000. The $100,000 is the excess coverage. I'm not going to be received imputed tax. Have to pay imputed tax on the first $50,000. So the $100,000 I do pay. So they buy 100 units at so $10 per thousand. So 100 thousands of coverage at 10 cents per thousand. So I've got 100 times 10 cents, which is $10, that's per month, times 12 months a year, I've received $120 in imputed income. Grace periods on life insurance contracts. So if you fail to make your premium, typically they'll give you another 31 to 61 days after the premium due date and before lapsing your policy. If the insured dies during the grace period, it is assumed that the policy then is still in force. And then the insurer pays the death benefit minus whatever the premium owed would have been. An incontestability period, we talked about this earlier, so this is for material facts. Generally, it is 2 years. The insurer may not cancel the policy if they later discover material misrepresentation or concealment. So if you buy an insurance policy and you die within 2 years, there's a good chance that the insurance company is then going to conduct an investigation. If you die after 2 years, then the insurance company has less incentive to conduct the investigation, because whatever they might find that you might have materially misrepresented would be incontestable at that anyway. Misstatement of gender or age, we talked about this. So women pay less in life insurance, younger people pay less in life insurance because the mortality tables tell us that women at every age die less often than men do, and younger people die less often than older people, less frequently. Misstatement of age will not void the contract. What will happen is they will pay you what the premium would have paid, would have bought. So, assignment of ownership rights. An absolute assignment is the owner transfers all policy rights. This may be the result of a divorce, or let's say my employer will assign policy rights to me if they bought a contract on me and then later want to give me the contract. Collateral assignment is basically, let's say I have a $1 million life insurance policy and I borrow $400,000 for the bank for my business. They say, hey, we want you to guarantee it. And by the way, your business is not worth anything as a financial planner if you're not alive, so we want you to guarantee it with life insurance as well. So that I would give a collateral assignment on my of my life insurance contract. So let's say that I borrowed, I can't remember what I said, I borrowed $400,000. If I die immediately, I owe the bank $400,000. They're going to be able to collect not the full $1 million, but $400,000. If 8 years into the contract I owe them $111,000, then they're going to be able to collect the $111,000 as the collateral, but then the remainder is going to go to my named beneficiary. So this is how collateral assignment works. Suicide is generally 2 years in some policies. In some states it's 1 year. There's an exclusion period. And if you commit suicide within that, your beneficiaries would receive return of premium. If not, too bad, they receive. If it's beyond that, they receive the death benefit. So if a life insurance policy lapses beyond, because you failed to make payment beyond the grace period, the policy may be reinstated provided that specific requirements are satisfied, and those will be specified in the policy. So you may have to take, that policy can be reinstated without evidence of insurability after the grace period, but there may be some other hoops that you have to jump through. There are no policy loan provisions. There are no income tax consequences for a policy loan. and the insurance rate is charged on the loan, except in the case of a MEC, they say, okay, you can call it a loan if you want to, but you're really taking money out, so we're going to charge you 100% ordinary income tax on the first dollar, because they're going to assume last in, first out. They're going to assume interest is withdrawn first. If you die with an outstanding loan on your life insurance contract, let's say I borrowed $300,000 and it's accumulated another $120,000 of interest, and I've got $1 million policy. I really owe the insurance company $420,000, and I die with that. They're going to just pay the $580,000 difference. Beneficiary designations. So this could be an individual, or I could name a trust, or I could name a set of individuals as the beneficiary. So this is a contract. Life insurance is a contract, and if I say in my will that I bequeath my life insurance to my current wife, let's say I was married twice, but I failed to update my life insurance contract, and it says the prior wife, then the prior wife would receive would actually receive the benefit. So the contract trumps what's stated in the will. I can also name contingent beneficiaries. So if I say I name my wife my 100% beneficiary, but I name my children contingent beneficiaries. If my wife dies at the same time that I do, or predeceases me, and then I die, then my children will receive it. If there's no valid beneficiary, then it will go to my estate and will be subject to the probate process. Life insurance proceeds, and also qualified plans and IRAs with valid beneficiaries are not subject to the probate process, but they will be subject to estate taxes if it's included in the estate. So if someone else outside my estate owns my life insurance contract, then it would not be included in my estate, unless it's my executor, and I instruct my executor to pay estate taxes on that. Settlement options for life insurance. So this is for proceeds. So the standard is the lump sum payment. I got $1 million, and life insurance, my wife's going to get $1 million check when I die. Actually, it's going to take them a little while to process it. She's going to get $1 million plus a little bit of interest. The $1 million is going to be tax-free. The interest is going to be taxable. Interest only, I could say, look, I don't want my wife to blow the money. I want the insurance company to invest it for my wife, the $1 million, because I don't trust her to do it herself. And so it will pay out interest only, and it will maintain the principal for some period of time or until some event occurs. I can also say, basically, I would like you to make annuity payments over, let's say I want you to pay her $100,000 a year. And it would pay $100,000. It would invest that money in an interest-bearing account and pay $100,000 a year until the money runs out. Or I could say, basically buy an annuity with it on her life after I die, and pay her a check until she dies, and then there will be no amount left. Or I can say pay her out over 10 years, and they'll say, okay, well, we can invest in a 10-year bond, and it'll earn this amount. If we invest in a 10-year bond, we'll pay her $117,000 a year for 10 years. Okay. Lifetime income with a period certain. This says, okay, if you buy the annuity for my wife's life, and she dies before 10 years, let's say she dies after 8 years, then the contingent beneficiary will get the payment on that annuity for the next 10 years. Or I can buy a joint and last survivor annuity. So I might, if let's say my parents might have it where they name me and my wife beneficiaries, and then they buy a joint and last survivor annuity income for me and my wife. That would be how that would work. I will not get into buy-sell agreements now. We will cover these in class or in the next recorded online lecture. And we'll get to buy-sell agreements because these can be funded with life insurance and with disability insurance and cross-purchase agreements. And then we'll get into disability income. And very good.